I recorded too.
And then yeah, you're gonna send me a link, post it on Twitter.
All right, comes the link.
Did you post it in the chat?
Yeah, here it comes, right there.
All right. Shall we start it off?
Yes, welcome back, George. Great to do another live stream. There's a lot to talk about since last week. A lot's happening in the markets, and if we want to start just with where we ended last week with a couple small cap stocks that Prospero likes.
Yeah, I'll actually go in and I'll do everyone one better and I'll kind of even show you part of my process for looking for them. Um, all right, I'm going sharing my screen here. So there's a few that I found um and two of them I found in the same way, but I'll even show kind of what I do when I'm just using the app so everybody can kind of learn a little bit about it. I'm looking especially in small cap, I'm looking for high growth. And I found two of them. And the way that I look at it is I'm actually looking for low downside breakout. Because obviously high growth stocks, there's going to be many less institutional bets against. And two of the ones I'm going to recommend are actually right here, ENVX and AXVL. And I can kind of go in a little and show why I like these. So a few of the things I'm looking for, obviously they both have very high growth. I like the upside breakout, especially because you're going to like, it's important that there's also like a lot of good bullish bets on it long term, not just many bets against it. I'm seeing good short-term signals. And I even for a stock like this, I kind of like a short pressure rating that's higher, but not too elevated, because that just basically means that there might be a lot of stocks, there might be a lot of people shorting the stock and they're going to turn around on it. Um, and so, yeah, we also have good net option sentiment and a good, I would say, path for net option sentiment here. I definitely like to see that. It's kind of a bonus if I'm looking at a high growth stock like this, that you're really kind of trying to own long term. And the one other thing that I will look for here, and Prospero does have plans to have kind of our own version of institutional flow that we're still working on. One of the things that I will do, it's actually like a new feature in Webull that I like a lot. Um, and if you go and look at this, one of the things, it's the Sage Tracker section. And by the way, I don't put any money in Webull because they're one of the companies that sells your data. So I just kind of use it for research. But one of the things I really like to see right at the top there, you see 0.72 asset management, which is SAC Capital, one of the smartest hedge funds. That was Steve Cohen's. Basically, the show Billions is based on him. And you actually see two buy-ins at a higher price that it currently is trading. Renaissance Technologies is pretty much the smartest hedge fund as far as it goes. In my esteem, not that many people know about them, but they're a quant fund that's been around in the 70s making ridiculous returns. So anytime I go in and I see those at the top buying at prices above where the stock is, that definitely makes me feel really good about it in addition to Prospero liking it. That's why ENVX is going to be my number one small cap stock. You also see DE Shaw, which is another very good quant hedge fund, and especially these quant hedge funds that their investors expect very high returns. That's a very different motivation than if you look at something like most sold here, and you're going to see something like Nuveen, Vanguard, Susquehanna. Those kind of places are bigger, kind of more ETF focused, are frequently the largest hedge funds that own this. So when they're selling, sometimes it can really just be, kind of rebalancing, which is why, when I see the quant hedge funds, that's really what I like to see the most. So this is the stock that I would say Prospero really likes. especially like seeing that high growth is very good for it. Um, I also really like their business model. They're kind of like a high tech battery company. So yeah, they're actually right under small caps, kind of cap at 2 billion, and they're right under that at 1.99. They might even cross it soon, but they're officially a small cap as it goes today. Which kind of leads into my other one. Very similar profile on the top to ENVX, even though this is obviously more of a biotech company. They actually have very similar profiles overall in very different industries. Also, a good trending option sentiment. So I like this one. I like for very similar reasons. It's a high growth company. It's a bit of a smaller company than ENVX, but I like to see companies that basically have this high growth potential. When you have growth potential in, say, the 80s or over 90 like we saw on the last one, it's very hard to have high profitability too, because a lot of the times those companies are spending a lot on R&D. So I would say those two very similar, and obviously what we're looking for is a much higher upside breakout than downside breakout. That essentially means there's a lot more people betting bullish than bearish in the market, and when I see high growth and a lot more long-term options bets, like on bull than bear, that's really what I like to see for a smaller cap company. And just to be really clear, the smaller the company you get, the more risk. But when we have these big growth projections, that's kind of what makes me feel safe, because even if a company is, I would say, hitting expectations, if they're ambitious expectations in terms of the actual growth of the company, I would say that's one of the things where a stock can go up, even just hitting earnings or revenue estimates, even be a little under it. A lot of it's going to depend on guidance. Whereas for a mature company, if they miss by even a little, their stock is going to go down. So this actually gives you a lot more wiggle room. Obviously, where a lot of the risk comes in is these are growth projections and less mature businesses. So it's harder to be as accurate with growth projections in less mature businesses. So if they do miss big, that could, especially if they guide a lot lower, or especially if a biotech company, if they don't get a trial or something like that, that can be a big hit. But I do really like this as well. And then the third one, I did not find this way. How I did find it was I basically looked at a filter of the highest upside breakout and growth. And this one even has a little higher profitability than the others. So like we're seeing, like actually very similar profiles on the bottom, in terms of above average net option sentiment, higher short pressure, but again, not so high that I think that obviously if they perform on their growth estimates, that those shorts aren't going to get out very quickly, which is why like all of these smaller caps are not short-term holds. You could see a profit very quickly and you could want to get out. But yeah, I would say those are my top three, as I promised, in terms of being able to deliver those this week, but with the added disclaimer of, the smaller stock you go. I know I already said this, and this one's only 115 million market cap, but we do see, good long-term options bets on it. Not as good as the other two, but you do get kind of more safety in this one with a 37 profitability combined with an 88 growth. That's pretty good risk-adjusted growth, I would say.
And I do want to mention, after speaking about small cap stocks last week, it's actually outperforming out of all the major indexes today so far. So that's interesting to see that the divergence is probably going to close over the coming weeks.
Yeah, and I mean, I think you'll always kind of see that, and I think the other thing that we talked about is the higher risk assets as the market gets closer to the bottom. That is, or kind of the turnaround or whatever. Even if we're still in a recession, those small caps I think will start to recover before even the general market, because everybody knows they have to get into those. Before all the buyers start feeling more secure and consumer confidence starts raising, they got to get in, because those are going to be the ones that are huge returns.
So it seems so far this year in all of the Prospero newsletters, you've been kind of bullish, which has been right so far. The market has gone up. but over the past couple of weeks, it's either been switching to bearish or more neutral. So do you want to update everybody who hasn't seen those newsletters on the Prospero stance?
Yeah, absolutely. And I mean, I do the same thing that anyone else is going to do in terms of like what I'm feeling about the market. 16 is that's in our bear territory. That's very low for QQQ option sentiment. So this would say I would say it's like reinforcing what I have on the week. And I have one of my trades right now is I am long SQQQ options. So I'm long levered options betting against the QQQ since last week. So I definitely have been bearish, and honestly, this is what I really like about this signal. I built this to really use it on its own. When you see low levels like this, it's very bearish. And the other thing that I did mention in the newsletter is SPY net option sentiment is definitely uh is has been pretty flatlined at zero. And as you can see here, like almost entirely at zero. That is a very bearish signal. And we've definitely seen, for those that don't follow the newsletters, these kind of have their own makeups, SPY and QQQ for other stocks, which is why I give levels for them every week. For other stocks, you could say if they're in above 80, they're kind of generally bullish, although I do go into some exceptions. But for QQQ, you want to see it above 30. And for SPY, net option sentiment generally above 10 is good because a lot of people use SPY and QQQ to hedge. So there are a lot more put options bought on those indexes, especially than any other stock. Um, so yeah, I would say that this is a very bearish territory. And essentially just what this means, like in simple terms of what net option sentiment does, is all about options pricing. And it basically means people are paying more for put options below where SPY is trading than call options above where SPY is trading at a huge premium relative to other stocks. And that's looking like the same for QQQ. So that's why it's a really good number to have. It's just very clear. It just basically says like the demand for options protecting against lower prices is much higher than the demand expecting higher prices of the stock or the index or whatever. So I think that's a really good indication. And like, yeah, it's one of those things that I've been also saying in the newsletter where it's like, yeah, it's something where you basically have um not great economic conditions. And we know it's still going down, and there's still this big divergence that everybody talks about, but I talk a lot about in the newsletters and just generally, where the market is betting on rate cuts this year. And Goldman Sachs actually last week backed off of that prediction and said, we think people are over projecting how much there's going to be rate cuts this year. So that's very interesting and powerful to me because Goldman Sachs, I would kind of like take their word above anyone in terms of like, they have a great reputation. They're not like, for something like that, I don't really expect them. Like, if it's a stock play, I might trust it less because I might think they have like an angle, which they always can. But they want to be right, and they want to be right for their clients and their high net worth clients that they're trying to get. So it doesn't really do them any good to be wrong about these things, even if they have like a trade. It's not worth the reputational value. Or the reputational hit. So yeah, I would say that this is definitely a big concern that they change their tune because the market is all about expectations. And if people are expecting rate cuts and then the rate cuts don't come, that could be very difficult for the market. So that is all to say, like, overall, like, there's no reason not to be bearish. But I do trust when I see the options markets, and why I have been bullish, and I guess right about that, is when I see bullishness in the options markets, that's what I'm going to say. I'm not going to overthink it, especially because we built the Prospero signals to kind of add clarity to what can be difficult problems and difficult things to predict sometimes. But yeah, now that like Prospero's negative on the market, there certainly aren't very good macro factors to support any thesis other than that. So yeah, I expect some bearish times ahead.
So do you see one factor that's the main reason for switching to being more bearish? Is it is it the rate cuts being pushed out? Is it inflation still remaining high? Or is it just a culmination?
Yeah, I mean, I think the rates and the inflation are very tied together. But yeah, I would just say that I would say that people seem to be a lot more sure that the rate cuts were coming, and a lot of the times is they can put pressure on the Fed. They don't want, um they don't necessarily want, the Fed doesn't want to pitch off like Wall Street and have them put money in. They like the stock market to do well, but they're not going to sacrifice inflation to help the stock market do well. They're not going to let inflation get big. That they don't care that much. But the thing that is, I would say, is playing into it more than, because I would say inflation is going in the right direction. And I would say that they probably didn't anticipate it to go better than this. I mean, it's beating estimates on Wall Street pretty consistently in terms of how fast it's reducing. What I will say is it's probably the surprising resilience from the market to start the year that's having them rethink it. Because if the market is going to stay strong, or relatively strong relative to what it could have been, then they probably feel they have more leeway to not not be as aggressive with rate cuts and really make sure that they're on top of inflation. So that's what I think it is more than anything. I think Goldman is, all of these models are complex and interconnected. So probably as the market has gone up, that's basically reduced the probability in Goldman and some others' minds that rate reductions are coming. Um, with the caveat there being that, like, any more economic turmoil, like if the market does get hit, like, I think you might see that come back, and you might see the bets going back up in terms of like, if people are actually expecting rate cuts this year.
Speaking of economic turmoil, the debt ceiling is on everybody's minds. And do you think this is something that people should really be concerned about, or it's going to be a quick thing and once it's fixed, the market will look past it?
Yeah, I think the thing about something like the debt ceiling is that Wall Street, this country runs on the stock market. It runs on our capital markets. If you say, like, we've got some great innovation, I always say that, like, because I think the way of our country is structured in terms of rewards, we do innovation, like, currently still, I would say, the best, although I would say other countries have been catching up. The gap used to be way bigger there. But what I would say is that uh the capital markets, we still are kind of king in that. And there is ground being made up there. But the country runs on that. So nothing, they're not going to let anything bad happen to the capital markets. And one thing about politics, and that's very consistent, is both the Democrats and the Republicans tend to pass very pro Wall Street legislation. It doesn't really matter. They both find their way to continue to pander to Wall Street. And there's huge donors on both sides on Wall Street. So yeah, like, they're going to get their acts together really quick if the debt ceiling is affecting the stock market. So I never really worry about that kind of thing where it's like gridlocked. If there's obviously things where there are difficult debates to be had that aren't just like, hey, we should just agree to a new debt ceiling. Like if there's actually like policy and differing opinions, like on both sides of the political aisle, I don't necessarily trust them to solve those things as quickly. But something where, like, the average American doesn't really have strong or informed opinions on the debt ceiling, so it's kind of just like political theater until something happens with the stock market, and then it'll get solved real quick. And that tends to be what happens with anything in the macroeconomics and as it relates to Wall Street.
I think I saw some kind of crazy stat where it's like just over 100 years old, the debt ceiling, and it's been raised like 80 or 90 times. So it's just going to happen.
Yeah, and I think both sides see it as an opportunity. Like, it's one of those things that it just isn't gotten rid of, because probably, like, when the other side is in power, they're like, oh, well, this is a pain, and that I have to deal with this and do it. But like, both of them know that we're on the other side, they love to hold the other side's feet to the fire. So that's why I think things like that stick around as opposed to being gotten rid of, because it's just an opportunity to, like, force whoever is more in power at the time to come to the table and give you what you want, which honestly I don't think is the worst mechanism, because in my opinion, our country gets very little done anyway. So if there's more mechanisms to kind of like force compromise and force people to say, like, hey, we have these other things that we need to get done that we're, holding hostage, which, by the way, on in terms of the particulars of that, like, I won't comment in terms of like what one side is actually trying to get done by like holding the other ones to the fire. That's not what I'm gonna. I won't comment on that, but I do think that that is why that mechanism is there, and that is why even if they have to raise it all the time, it's they both parties just like to be able to say like, oh well, we'll just hold out on this until you give us what you want, give us what we want. So I think that's why those things exist. And yeah, to your point, it's not a real obstacle, and it would never really cause real economic impact, because the second it even did a little, all of the people that really run this country, the large political donors, would be on the phone screaming at whoever was holding up the situation.
Could we possibly pull the Prospero app back up and look at, I believe on the home screen, it shows five stocks that are your bullish for long term, short term, and bearish for short term. So, could you speak about how those five stocks are chosen and how often they're updated and just what that's about?
Yeah, I mean, obviously, as we look, it's been a really good run for the top here recently. Um, and we see, basically Meta had a big gain. We saw CELH last week up over 20% in a day. First Solar, same thing. We talked about AMR that's spent a lot of time up here recently. And it's actually just like really simple why we call them our safest long-term bets, and why we say we would have our families invest in them, is it's basically just upside breakout minus downside breakout plus profitability. So basically, sometimes you could basically have a lot more bull bets than bear bets, which is high upside breakout and low downside breakout. But sometimes you could have pretty low profitability companies in there. So it's just like, Meta is the perfect example of life number one. Very, high max upside breakout, lower downside breakout, high profitability. First Solar was something that did very well. A little higher downside breakout, but obviously really high profitability and good profitability plus growth there, which is actually something that like I did want to talk about a little. This is one of the highest ones, but obviously these are all like, this is a great place to look. And I would say, especially in this economy of just like I would always advise loading up on, especially if you own a lot of longs, just buying all these stocks. People that do that have been very, very, very happy. I wrote about one of my friends that actually works at BlackRock that other thing that I look for, other than high upside breakout and low downside breakout, that if you're ever just like here and look, like this is very high profitability plus growth. Um, and basically what you can do here is, if you ever see, like I was just looking at this today because I was like, I should have talked about this, because I've been looking at this as a high profitability plus growth stock, and this is up 20% today. Obviously, what we're talking about, very high upside breakout and low downside breakout, but not as high as the other ones, which is why you don't see it in the top 5, and 61 profitability is a little low. But obviously something like 142 profitability plus growth is very good. And that's good because obviously growth is great, but sometimes if you're seeing like very low, like sometimes you'll see profitability below 10, and you might not, EPS is what drives stock price, so you might not really see great appreciation there, or like soon, even if there's growth. But you see something like this, and I just feel like as long as there's not some major shock to the business, which by the way, biotech, this is another biotech company, those are kind of like the highest risk, I would say, in this category. But obviously, high risk is high reward as well. And this stock was, just doing great, and has been very high in net option sentiment too, which is what we like to see, and just like up very big today, obviously. But yeah, like we saw it before it went up big, and sometimes you do see, like, even if though the stock is spiking, it went up 40 points today, it still has relatively high net option sentiment. But like, yeah, it closed the week on a big upswing before this, which is like, I would say, us predicting this kind of thing very well, especially because you're not seeing these lower lows. When we see higher lows, like you see a high of 88 here, or sorry, a low of 88 here, and like before it was 68, 74, 80, 86. So there were some higher, but the 88 is obviously a very high low. And then it was just in the 90s before it shot up. And you will see net option sentiment go down when the stock goes up sometimes, big, because that's people closing out their options positions, and you'll see the price of those options going down. But yeah, this is something that, obviously, if you're in Prospero, anytime you see a company that has, I would say, profitability plus growth above 130, that's a stock that I would say we really like. Even if these upside breakout and downside breakout fundamentals aren't as good, I would say we still like it. When you start getting higher downside breakout than upside breakout, then that starts to get something where I would be less inclined to recommend. But like if you saw something with 80 profitability and 80, let's say, and even you had 50 upside breakout and 40 downside breakout, I would still consider that a pretty good buy, because stocks that are going to grow and be so profitable, it's very hard for them not to go up, regardless of whether people are betting on them in the options markets yet or not. It could just mean that as it gets closer to the reporting, those options bets will start to come in, but you'll be kind of ahead of all of that.
And so how often are the stocks shown on the home screen updated daily?
No, every 3 minutes.
Every
Like
three minutes, okay.
these don't change that much because they're not designed to. Like long-term options bets and things like, analyst estimates, which is a lot of what we're based on. We do some of our own things in addition to that in terms of how we estimate on top of that, but it's largely driven by analyst estimates. But yeah, you're not going to see a substantial change in profitability, which is one of the three metrics here. And then, yeah, funds don't necessarily tinker with their long-term options positions that much on a daily basis. So these do change big sometimes, but it's going to be much less frequent. And that's actually why we do net option sentiment and upside breakout and downside breakout. Net option sentiment is isolating just short-term options expirations. And obviously people play around with that a lot more. So that's why you'll see this. This is a new stock today. But you'll see this fluctuate a lot more. And this could easily not be here the next time the app is updated.
Meta is a stock that's been a staple in this list for a long time now.
Yeah, short and long.
Yeah. And they're still
Yeah,
looking
I mean,
good even after all this move higher.
you see pretty high, you pretty see it consistently high in net option sentiment. Social sentiment has stayed pretty high. Like that looks like a bit of a dip last week. But yeah, we see it consistently. Downside breakouts going up a little bit, which is just something to keep your eye on. But yeah, I mean, it's just pretty simple, whether or not it's something that will happen immediately, because we consider a short-term options bet anything less than 9 months. So there are kind of some things longer, and long-term is over a year. That's what goes into upside breakout and downside breakout. So it could be non-immediate, but the market is very bullish on Meta, and it does make sense. I think it was really hammered a lot more. Like if we go in and look at their PE, which is obviously price divided by earnings, which is just a very good traditional. Oh, look, it's doing very well today. Even though I don't think the market is, but I haven't checked again recently since this started. But yeah, it's still like 24.3 is a bit higher, but yeah, it's still a relatively low to where it was trading before, and obviously a lot has come down. But yeah, I mean, I think that it's just something where ultimately it's a good business that I think was really hit pretty hard for the metaverse. But if you look at it now, they've pivoted and they're going to get a lot more into generative AI. And if you look at it, like metaverse was kind of like a resource suck that everybody, I think, was punishing them for. And now when they've shifted from that to generative AI, which is such a hot thing, like it's hard not to see them continuing to be valued more, especially because they have a very strong team in AI, and they've done that kind of like graph search, like text analysis, a lot of the cores of it. Like, what smart AI people say about generative AI is like, yeah, Google, and we talked about this, kind of has the smarter brain, but now OpenAI has all this like live user data, which is very important to drive in terms of training and in terms of what people are asking, and that is like almost the most valuable data. So they have that, but if you think about Facebook in terms of what it has about like conversations and what people are talking about and all that, it's not quite what OpenAI has specifically. But they have a lot of experience with that. So it's very easy to see them being a big player in generative AI, especially because, there's a lot of people that still don't use OpenAI. And I think businesses are starting to use it a lot more. But if Facebook rolls something out that is even very similar to OpenAI, that's just kind of greeting you in the app for a lot of people that don't necessarily know how to use OpenAI, that could be something that is, very popular and used, if they can execute properly and build a good thing, they could catch up really quickly. And that could be a big business for them.
I've heard that people talk about the year of efficiency for Facebook as well. They seem to be one of the companies that's really trimming their workforce and using AI within their company itself to get that EPS higher, you know.
Yeah. Yeah, it's like what we talked about. Like I think it's not only we talked about with Google last week. I think it's not only like the actual cost cutting measures, but I think, they're keeping more key people, trimming the fat. And then the people that are still there, I think a lot of people at these tech companies were getting pretty fat and happy and not necessarily working that hard or feeling job insecurity. But all of a sudden you do that and you say, hey, like especially with a recession coming, like if I could, you know, if my job's in jeopardy, I'm going to try that much harder, and you're going to be getting more efficiency and more output in addition to kind of cutting the lowest performers. So that could be a big, that could be a big lift. And especially something like, yeah, we're talking about catching up in generative AI. You have a talented, motivated team, could potentially catch up, very quickly, increase efficiency, especially if you have a, a willingness to roll out new products and try new things. And I do give Zuckerberg credit for that, or the board or whoever, to say like, hey, the metaverse wasn't working. And obviously a big part of that is like crypto as a whole just like got way less valuable and way less interesting. But that's important, to be able to say, hey, this isn't working. Let me pivot to something that does. As a large organization, and Zuckerberg doesn't need to, you know, prove anything to anyone at this point, and he certainly doesn't need the money, although I'm sure he likes to see his stock go up. uh it's something that is commendable that he said, hey, this was something that I was super passionate about. And obviously you take a reputational hit to take this big foray and basically admit that it was not smart, but he did that, and it's paying dividends for him.
All right, there's two other uh, popular retail stocks I want to cover. One of them was Disney, which reported earnings last week, and it was pretty mixed results. The stocks traded a little bit lower after it, but you want to talk about Disney and the overall streaming industry as a whole? Because it seems like the
Yeah,
market
I
is
mean,
not liking streaming right now.
I think we talked about that, and I can pull up Disney as we talk over this too, because you definitely see Prospero um souring on it as well. But yeah, I think part of it is it's just like when you talk about all these streaming services, and yeah, we see like an uptick and then way down to 53, which is just not very good for it. Yeah, the downside breakout is almost up 10 points. So that's a pretty big indication that like what we're talking about right here, like a lot more bets in the last 10 days against Disney in the long-term options markets. Um, but yeah, I would say that part of it is just that it's just too crowded. And like I think part of people's issue, like why they started switching from cable, is that cable got really expensive. And now with all of these streaming services, like you can probably end up paying more. And I recently got Paramount and all of them. It just feels like a Peacock, and they're all just like, before, when it was a little more consolidated under Hulu, it was a lot easier to just be like, hey, I'm going to cut the cord or whatever. But now, like Max and Disney and there's so many, like at a certain point, it almost adds up. Like cable almost becomes a value again, or it becomes so many where you're just like, okay, which ones of these do I want? Because like when you start paying for like 5, 6, 7 streaming services, all of a sudden you're just like, well, this is too much. Which are the ones that I actually use? um and yeah, I would say like Disney is one of them, and Apple's coming on strong too. Didn't mention that. They're making, I would say, more original shows, and I would call Disney one of the weaker ones. And maybe they're not forecasting. I know their subscriptions are growing, but yeah, I would say that there's that, and then there's actually just like, I would say, the theme parks are still really good, but I would say that, a lot of people, I would say with COVID, like there's kind of an existential risk to something like theme parks now, where you're just like, they could be making money, but you kind of have to discount that money a little bit because you don't know if it's going to get shut down again or whatever. Also, Mickey Mouse, the trademark, the original trademark is coming up, where people are going to be able to use, I believe maybe it's the end of this year, use his likeness. And I think maybe that's like symbolic more than anything, because I think it's just like one specific instantiation of Mickey Mouse, like the original, I think black and white version or something. But I think that's kind of symbolic of like, oh, like this might be a giant that is starting to fall. But yeah, I would say obviously Netflix is just highly efficient. And I think that's something that is just like, they were around first. There's so many people that just like flock to it and use it. And I would say they have so much content that that's just a difficult one for people to cut. And it's like the most ingrained in, I think, what they've done. And I think their amount of shows, like even if people don't necessarily have like, I think like obviously, a lot of people get Apple for something like Ted Lasso, and like, like a flagship show like that some of these places have. HBO, I think, is great with that. Like, I think it's probably like the second most, or it's going to be Max now. I think that's probably the second most defensible one, because they're great on those flagship shows, where some people just might have one. But yeah, there's some other ones that, like, I would say, like, obviously, I think it's Paramount that has like Yellowstone, that a lot of people, I wouldn't call that quite like flagship, but it's something like that. But I think what Netflix has is it just has so many shows that at least one per, like, at least like most people have like one show they watch on Netflix that they really love, that's going to be enough for them to keep doing it. So I think that's why it's the most defensible. But some of these, like, yeah, if it keeps on spanning out, I think people are going to be like, do I really need, like, do I really need Peacock and Paramount, or like whatever? Do I need all of these when my bill is ballooning up to like $80 or more for these streaming services? When like maybe cable and internet was like 100, 130, and people are still paying for internet. So I do think, it might not be the same ones being cut by everyone, but I think there's obviously a safer one like Netflix or Max. And then there's a lot of ones that I would just call less safe because, for different reasons. I would say like Max is very good at those flagship shows, and Netflix just has like the breadth of content. And then a lot of them are just like less defensible than that.
And I believe HBO is Warner Brothers, right? And they have not got their footing since they've been spun out from AT&T, so that might be a stock people can look at.
Yeah, definitely. I don't even, I haven't checked that out in Prospero, but I will.
It sounds like what you're saying is there's going to be a lot of condensation and maybe even some streaming services that go out of business or get acquired over the next coming years because there's just way too many for the market to buy all of them.
Yeah, I mean, it might be that, it might be here, I can pull up Warner Brothers Discovery, like, or it might just be like, I don't know, like, because a lot of those are like big, like Paramount, like a lot of them are big places that have been around forever. So I mean, maybe the stocks will just get hit versus consolidation. Like, I don't know. Like, it's funny, you look at Warner Brothers and it's actually like Warner Brothers Discovery. So like there is like, yes, those media conglomerates are getting bigger and bigger. But it's actually pretty interesting what we this is kind of the reverse of some of the stocks we were looking at earlier, where I was like, oh, let me pull it up if it's interesting. But yeah, you actually see Warner Brothers Discovery having like some good long-term options profiles in terms of like that higher upside breakout and lower downside breakout, but below average profitability and growth. So that's kind of what you were talking about there, right there, where it's just like, yeah, like the business prospects might not be as good as these stocks for these stocks, but maybe like, maybe some of what we're talking about there is people thinking that this business is more defensible than some of the other ones. It looks like there was a big hit to like a lot of the streaming things. We can take a look. Like, yeah, it looks like declining upside breakout, which is never what you want to see. But I guess 75 to 72 in 10 days, maybe just a little, you can call that some volatility. Yeah, and a pretty narrow band of performance in downside breakout. So yeah, I mean, it looks like it didn't get hit nearly like Disney did. which is kind of the point that I think we were making as well. So Prospero seems to support that.
And the other stock I wanted to talk about was Tesla, which is the king of retail stocks, I would say. And they got a pop last week once Elon announced that Twitter is going to get a new CEO. So do you think that's just a one-time pop, or do you think that's actually bullish for Tesla in the long run?
I would say that like, and I keep going in and out. I should just stay in there. I think that I think that Tesla is going to do well long term, like regardless. Like I think it's very hard when you get a stock that has like so much growth priced into it. But like it's also hard because I think a lot of people don't realize that Tesla is also a battery company and like an innovation company. It's not just a car company, and they have a huge battery plant that they're building. So how to price it, and obviously very good, but we're talking about very good profitability plus growth. We kind of said 130 was the number that if you got above, very strong. And it continues to be great. One thing I do see is, obviously it's nice to see less like higher lows recently in this net option sentiment. That's something that we talk about. Social sentiment is always going to be pretty high for it. That's no surprise. But we are definitely seeing, even though there's a pretty narrow band, like 85 to 82, basically. So not a lot of movement there, but I've definitely have been seeing downside breakout go up, and it was way lower even like a few months ago. It was like in the 20s and 30s. So yeah, this is worth watching. Like those two values are converging a little bit, which could mean like with these short-term signals, it could mean that we do have some price appreciation coming soon, or it might not go in that direction. But yeah, I'd say that that's the main thing. That there's uncertainty around this stock, and uncertainty in the metrics. Even if you have these high short-term things, the longer-term ones are not necessarily performing like that. And that's just because you're going to get a lot of speculation. And as you can see, like some decent volatility in the now option sentiment as well. But it's always going to range high because I think you just have a lot of people that are just betting on it in a pretty standard way. It's just like one of the easiest stocks to speculate on.
Yeah, and the last thing I wanted to cover today specifically is algorithm trading in the markets and zero-day options and how they're affecting how the market is moving. I've seen a lot of people talk about how these factors are making the market revert to the mean at the end of day. And if you just want to talk about what you're seeing with that and the market moving.
Yeah. I mean, I definitely think one of the things that we are seeing is a lot of corrections. At the end of the day, if one thing going in the other direction, sometimes I think Friday was a really good example of that. You kind of had a very bearish day that like charged back at the end. I think that that's probably why people were talking about that a lot, because nothing really changed. It was just like there was not really any big macro announcements. There wasn't anything, and it was just like a pretty bearish day that recovered. So I think that is happening, and a lot of it I would say is it's not only so 0 day options are I would say one of the mechanisms that makes it easier for that to happen. But a lot of it is just like I would say momentum trading and algorithmic traders. Because like once you start going in a lot of directions, it's just like I would say just like a lot of robots agreeing. You basically get some things that are just like forecasting the bottom, and then they trade in certain patterns that say like that alert other robots that the robot traders are coming in, and then it just kind of gets more robots. And I think that like a lot of people call that manipulation. And we've kind of talked about that in the past, but it's just a fact of how the market works now. And it's just like one of the things that like I don't understand, and I use this analogy all the time, is that like you don't hear people on Coach saying it's unfair that people can buy first class tickets or get in a different security line because they paid for Clear or whatever, or even fly a private jet. But for some reason, when the same level of service is offered to wealthy people where they can get like better execution, better algorithms that know the market more, like all of a sudden that's like unfair and they're being robbed or whatever. And that's what I don't really understand. Like, I'm not saying that it's fair anywhere. That certain classes of products are offered to some people or whatever, but for some reason with the market, people get much more offended by the idea that there's not like equal service and equal execution, and nobody really promised anyone that. That's the thing. Like they just like they act like it's a violation of their fundamental human rights, but nobody promised anyone that. There's no real as these market makers get bigger and everything like that, they're actually all following the laws. And like I think what a lot of people don't know is that dark pools were created for more transparency, because before people just made those like block trades and everything like privately, so you got even less of a window into what was happening. So those did add transparency. So like some people, it's and laws were created for that, and laws around that are obeyed. And like I don't consider, and like obviously the reason I started Prospero is I think there's a lot of structural unfairness that should be corrected. But like a lot of people need to empower themselves more and realize that like the government didn't promise them these free markets. The governments promised the laws that existed, and those are what existed, and they do enforce the laws. But the problem is Wall Street is very good at making the laws work for them. And a lot of corporations and the bigger they are, the better they are at making laws work for them. And it's just like when Monsanto is like adding chemicals to everybody's food basically, and like or doing a lot of other horrible things, like you don't really hear as many people complaining about that. You hear a lot of people complaining about Wall Street when like nobody's dying from it. And like I think a lot of the and obviously Prospero is about leveling the playing field. I just think people need to take a much more active role in making that happen as opposed to just complaining. And yeah, to go back to like what we were talking about before, like, yeah, 0-day options, like I should say very specifically, nobody should trade them. No retail investor should ever touch those, because you are up against robots that know a lot more than you ever could and are much better at execution than you can in terms of like momentum trading specifically. And that is a momentum investment. I'm not saying nobody could ever be smarter than an opposite hedge fund trader. I don't think that's true. And I think people make themselves like, I do think it's possible for an everyday person to see something that a hedge fund doesn't in an investment, in a value, in a company analysis. But if you're talking about a 0-day option, no, a retail investor cannot know more than a robot that's been trained and understands like petabytes more information than your brain can like hold and analyze and most importantly execute on, because you could know the same thing as a robot exactly when they know it, and they're out long before you, even if you place the trade at the same time, because of how the markets are structured. So you're just behind on various levels, and it is not a smart thing to do. But yeah, back to the original question, like yes, 0-day options are essentially there comes a time when the risk reward of like buying a cheap option that might turn around becomes much more attractive. And then when people start buying those options, that creates more momentum to send the market in that direction. So sometimes it's just risk management systems that are buying those options that then get like create the robot army that ends up following them and creating momentum the other way. So yeah, like it's just honestly, it's like risk pricing and risk management that I think are starting these trends a lot of the times, where it's just like if you can buy an insurance policy on the market turning around super cheap, a lot of these automated traders will just buy that and then end up creating like velocity and acceleration the other way around those risk management practices.
So firstly, I think the industry should think about renaming dark pools to transparent pools, if that's the case of what you're saying. I think that was bad branding on that. But also, if you're a long-term investor, should you worry about chart patterns or should you just look at fundamentals? Because those are what ultimately drive the stock in the long run, correct?
I hate technical analysis, and I'll tell you why I hate technical analysis. Um, because it is built on statistical models, linear statistical models. And when you're drawing a line to predict something, you're basically saying like, if everything goes according to the most regular circumstances, then this line is going to be correct. But you're basically ignoring all of the non-regular, non-average circumstances. So basically, when you use technical analysis to invest, you are just doing like the most fundamentally easy thing by saying like, okay, if everything stays normal, like I'll make money here. But the problem is like when it's not normal. And I do think, by the way, that like you can make money in technical analysis if you have good stop losses and you're basically like, if things go abnormal, you have good exits. But I think people become overconfident in technical analysis and they start to believe just because it is right, like more than it's wrong, because it's basically saying these are the normal conditions. The problem is when it goes wrong, you can lose a lot more than you made. Like, because you're basically saying, oh, the technical analysis says this is going the other way, let me buy more. Or there's lots of different ways to do that. But yeah, like I don't consider that a great data point if you're just basically saying like, oh, as long as like the line is true, like like that's not really adding that much. I do like it to support my thesis. Like if I believe something already, like and I say, oh, like the technicals look good too, that's great. I'll always check them. But like I think where people go wrong is where that's the start and the end of their analysis. And to your point, I would start with fundamental analysis. I would make sure it's a good business. I would make sure it's growing. I would make sure the profitability is good. I would look on Prospero and make sure that like the options bets are where you would like them to be, and like especially the long-term options markets. But yeah, like I think people are doing themselves a huge disservice if they're only using technical analysis, because you're basically just saying if the market performs as everybody expects, then this is what's going to happen. But like fortunes are made and lost on the market performing not as expected. So I would consider technical analysis alone purely a false sense of security.
What about RSI? Do you look at that at all when investing?
Yeah, I mean, when I look at technicals, I look at MACD, I look at RSI, like those are the main ones that I like, and I look at. And I'll look at MACD, like that's like one of the charts that I look at all the time. Like RSI I'm definitely aware of, because I think like if something becomes very oversold, um, that is it's very risky to bet against an oversold stock. Like for sure, 100%. Does it mean I'm ready to bet for it? No, absolutely not. Not if like the rest of my analysis doesn't agree. But like the bottom line is there's a lot of robots that trade on these things. So it's not a bad idea, but it's like the same thing that I tell retail with like dangerous meme or like small cap stocks. The problem is you don't control it. Like especially the smaller cap that you go, like you could see a great RSI and then like you don't know, like an attractive like oversold thing, and you don't know when the institutions that are in at the same time are going to get out. And like just like what we said, you could be out of luck when they've decided that it's now become overvalued, and you're just sitting there and they've all gotten out, and like maybe you have a stop loss, but even if you have a stop loss, you're going to get execution after them, like in almost every broker that you're in. Which is why it's just like it's always better to trade on, like I would say, more solid fundamentals, even the fundamentals that we've kind of created, where you're looking at options bets. Because especially if you're careful, and if you're looking at like, especially if you're lining up a lot of these things, in addition to just like having a company that I would say is on the upswing versus on the decline, you can really create a situation where you can have a good hit rate like we have in our newsletter. I think we're going to publish our 6-month results. I think we're around 70% right still. So there's ways to do it, but you have to be, you have to be careful. And I think you have to have a system and a process. And I think there's way too many people that just trade on technicals, and it's just like, it's not the right way to trade, because you're basically just, you're very dependent on data that actually explicitly doesn't work in non-normal situations. Normal. So any change in the market, any rapid change, it's going to break. And then you also have the problem of like all of the robots kind of trading on those signals, and that they trade on those signals, and you're going to be behind in line from them.
All right, I think we covered a lot of good things here today. We have no questions in the chat, unfortunately. I think next week we should be live on the Prospero.ai YouTube channel, not on this Foster Finance channel, which I'll add into the description when I go into this on YouTube. Is there anything else you wanted to cover, George?
Nope, I think that's everything.
All right, so if you guys enjoyed this video, we post shorts from it on the Prospero AI YouTube channel. And if you're not able to watch the full thing, you might find those interesting. We post 4 to 5 a week. And thank you for tuning in. And we'll be back next Monday, 11 a.m. And See you there.
All right. Thank you.
See you later.